Our Region's Business is sponsored by PNC for the Achiever in You. Welcome to Our Region's Business with your host, Bill Flanagan.
Today on Our Region's Business, strengthening communities by building wealth individually, plus preserving family memories in a professional way. But first, a look in the crystal ball with a few predictions about what's in store for the economy in the year to come. Are oil prices down for the count, and just what does that mean globally as well as regionally? Well, Stuart Hoffman is back with us, as he is every year about this time. He's chief economist for PNC, which is, of course, a sponsor of this program. Welcome back. Good to see you again.
Good to see you, and we mark time by these annual outlooks.
Yeah, I guess so. Hopefully, you're the dismal scientist, but I hope you have glad tidings to report as we look ahead to 2015.
I think I do. And even this past year wasn't so bad, and looks like it's going to end on a good note after, of course, being frozen out in the winter.
Yeah, really slow start with last winter.
Actually, a decline, a step back, but I'm not a weather forecast. I'll leave it to other people on this channel. But from the economy's point of view, you mentioned oil prices coming down. I think that is a big net win for the U.S. economy. Of course, there are winners and losers. And in this region, a little losers in the shale gas, but I think many more winners regionally and definitely across the country. So I've actually upped my forecast for economic growth for next year, upped our increase in jobs, brought down the unemployment rate. So we think we'll create 2.75 million jobs across the country, a little better than this year. Hopefully a year from now, the unemployment rate will be in the low fives, 5.2. Right now it's about 5.8. So instead of giving you a high five next year, I'm going to give you a low five.
Low five, yeah.
I hope. And that should be good. And certainly consumers are loving this drop in oil prices, and every penny saves all us motorists added together $1 billion in money not spent at the gas station.
$1 billion
per penny.
Per penny. That's crazy. And to have it happen here at the holiday season, it has to be good for the kick it always gives to the economy at the year end, right?
Yes, and a year ago, gasoline was about 75 cents a gallon more than it is right now. And, that's 75 billion. Now that's at an annual rate.
Sure.
But that's like divide that by 12. That's $6 billion, probably in the months of November and December. That just filling up your tank will be less. Now, for any individual, it might be 10, 15 bucks a week or double that a month. But it's a big, big number when you consider how many people have cars and how many people drive. Plus, jobs are up. The stock market's up. House prices have started to rise again across the country. And consumer confidence is better. So if that doesn't spell a good holiday, I don't know what does. And I think we're off to a pretty good start. And in these remaining days, I think we'll have a decent finish.
Now, all those factors, you start to get the economy heating up. We've been waiting for years to see this happen. I mean, at some point, the Fed's got to be keeping an eye on all of this, though. Any dangers out there of inflation or the Fed having to crack down at all as part of all of this?
Not crack down. I mean, the Fed just had a meeting and announced that they're going to be patient, was the word they actually used in raising interest rates. We've been coming on here for the last, 6, 7 years and said there's no chance the Fed's going to raise rates in the coming year. Well, finally, we do think around the middle of next year, these rock bottom low interest rates are going to start to drift up. That the Federal Reserve will say the economy's doing better, the unemployment rate is down, not to let interest rates start to sort of get up closer to normal, although that won't happen all next year, could unleash that inflation problem down the road. So I think it's a wise and prudent thing for the Federal Reserve, say summer of 2015, to start to let interest rates move up a little bit. But I think it'll be going on in 2016, 2017, and it'll take maybe 3 or 4 years to get from what I call zero to normal, which for short-term interest rates be about 3.5%. Today, they're 1/4%.
Right, so even 3.5%. It seems like high interest rates now. We've gotten so spoiled by zero interest rates.
Right.
But still even a couple of years to get there, which is pretty remarkable. You did mention one of the consequences of oil prices, of the low oil prices, is it's depressing energy prices in general, and that seems to have softened demand for all the natural gas reserves and some of the activity that we have here in the region. So there is a little bit of a potential downside here in our region, is there?
There is. but I think it's still a net positive because I think transportation, all the other things we have going for us in this region, transportation, retailing, tourism, business services, those are the businesses that get a little bump from this. So yes, there's a net effect, and there are going to be winners and losers. And I do think it'll slow down maybe the exploration of shale gas. But I'm still thinking Pittsburgh's going to have a good year in 2015, following the U.S. Probably won't grow as fast as the U.S. grows jobs. Our unemployment rate locally is already close to 5%.
Sure.
And so maybe it doesn't fall a lot further, but it stays there. So yes, a little bit of a local drag. But let's face it, as important as shale is, and is going to be, I think, for years and decades, the number of jobs in the shale and energy business are still less than 5 out of 100. So we have a lot more going for us in other non-direct energy-related businesses. And those that use energy, all the manufacturers and retailers and everybody else who uses energy as their cost of business, I think get the bigger break and are the bigger winners.
Wow. And so still, if somebody's out there looking for work, thinking about the future, it sounds like a pretty good, solid picture going into next year in terms of opportunity here in the region.
Yeah, and even in the energy business, because I don't think oil prices are going to keep falling for years.
Right.
In fact, I think they've overdone it on the downside. They're below $55 a barrel for oil. As you know,
which is hard to believe.
Which is hard to believe. They were 100. So I think there's a little bit of, markets always overreact, especially with speculators. So I think they're pushing it down. Our forecast for next year assumes oil will be about $70 a barrel. Let's say in a real broad range of 60 to 80. So we actually think this is an overreaction. And if oil prices and gasoline drifts up a little next year, that's not such a bad thing. We're probably still not even going to see gas at $3 a gallon, except maybe next spring, summer when they peak before they go down again.
Crazy times. Amazing. Well, thank you so much, Stuart Hoffman from PNC. It's a little holiday cheer.
A little cheer, exactly right. No humbug here.
All right, thanks so much. Next up, a new initiative to connect inner city residents to in-demand jobs in the natural gas industry. It's called the Mentors Community Wealth Building Initiative, and we'll find out how it works when our region's business returns. Stay with us.